Well, the Asian markets, it's a sea of red across the Asian markets. No two ways about it. The Nikkei has tumbled almost 3%, a 765-point cut. And this is following a sharp sell-off on the Wall Street yesterday, where we saw the Dow correct by about 600 points. The Nasdaq down by about 4.5% as well. What is aiding or adding to the pressure on the Nikkei is the strengthening of the dollar yen. For major part of this week, it had been trading above that 112 handle, and now it's slipped below that, or rather strengthened below that. Not good news for Japanese exporters. Trade war worries between US and China taking the Dow lower as well. And we are seeing that fall extend. Across the Asian indices, the Korean index down by about 2.6%. In fact, the one which is outperforming is the SGX Nifty. The others are all lower by about 1.5% to even 2.7%. SGX Nifty in that regard is down by 1%, and it will be very important to see where it goes from where it is opening, because it is the October series expiry and bulls are sitting on a fair amount of ammunition. Add to that, we have crude prices which are lower, which could help us help our cause. However, the weakness in the global markets will reign supreme.
Okay, well, let's tell you about the US markets then. It was a brutal sell-off on Wall Street, with both the Dow Jones as well as the S&P 500 giving up gains for the year, and the Nasdaq now entering correction territory. There was a drop in tech shares and worries about corporate earnings that added fuel to the fall. CNBC's Aditi Roy gets us a wrap of all what took place on Wall Street.
Stocks plummeting on Wednesday as a sharp drop in tech shares and worries about corporate earnings added fuel to this month's pullback. The Dow dropping 608 points, erasing all of its gains for 2018. The S&P falling 84, also turning negative for the year. And the Nasdaq plummeting 329 points, just under 5%, entering correction territory as Facebook, Amazon, Netflix, and Alphabet all traded lower. Netflix falling 9.4% as investors second-guessed valuations. AT&T also dropped more than 8.1% after releasing its early quarterly results. Bank shares falling on fears of slowing growth for mortgage and other loans. Shares of JP Morgan Chase and Citigroup both pulled back more than 1.5%. B of A stock dropped 3.1%. Some bright spots, though, included Boeing. Its shares jumped Wednesday and remain in the green after hours after the company reported stronger than expected quarterly profit and cash flow. Demand from commercial airlines drove a surge in revenue, pushing shares up. And Microsoft's shares also surging after the company beat Wall Street's expectations Wednesday, reporting earnings of $1.14 per share compared to the projected 96 cents. Revenue rising 19% overall, and revenue from Azure slipping from its 89% growth last quarter, telling 76% increase of revenue. And Tesla shares soaring as much as 13% in the after hours as the company beat analyst estimates on earnings and revenue in its third quarter results. And finally, Ford shares rising 6% after hours after the company also exceeded expectations on earnings and revenue in the third quarter.
Okay, well, on that note, here is what market experts have to say about the US market.
What we are seeing from markets right now is an inherent fragility. Volatility remains high. Investors are shooting first and asking later. And in response to a lot of comments coming out of companies, none of them overly concerning in and of themselves, but nevertheless, investors are looking at them and saying, I'd rather just take down my risk right now, and I will reassess what these issues are. The concerns that people are citing now are the same concerns that we've seen at the beginning of the year. And when we look at the earnings backdrop coming out of corporations, we have their comments. Yes, some of them people are gravitating towards, but by and large, the results so far have been pretty spectacular. The breadth of companies beating is very strong, 75%. The amount they're beating by is right in line with historical averages.
The very rapid move higher in 10-year yields, 20 basis points in just a few days. That stabilized, so that's a check. Then we had a little bit of an accelerant to that fire, which was a lot of the systematic selling that had to take place. As you had both bonds and equity selling off, volatility jumping higher. We would say that's largely complete as well, so that's a check. But then you were supposed to be left with really your fire extinguisher, that are fundamentals, that are earnings. And that's where I think we're still going through a little bit of a digestion, resetting of expectations phase, where it goes from, yes, earnings are really, really good, but we're probably past the phase where we're just revising earnings higher and higher and higher. So now we're thinking about, wait, maybe 2019, 2020 earnings expectations are a bit too high. Maybe they actually need to be revised lower.
You've had no safety here in October where bonds are down, equities are down, and I think that's been exacerbating some of the selling from the multi-asset community as well. I think from are we good from an equity perspective is now a good time to buy. You've had a derating that's in line with what we saw in 2015 and 16. We hit a level and a multiple yesterday that we hadn't hit since the depths of January 2016 when earnings hadn't grown for 18 months. We had a dollar shock.
That's interesting.
And we had an oil shock.
All right, across the Atlantic in Europe, almost all markets ended lower, dragged down in late trade by another slump in the US markets on the Wall Street. The German and the Italian markets, they were the big underperformers. The Italian index ended with a cut of almost 1.7%. We saw the peripheral indices also in the red. The only index that really stood out in terms of gains was the FTSE, which was higher by about 0.1%, but not much in terms of gains as well. We had a sharper cut across the other indices. If you take a look at the emerging market space, there were divergent moves out there. The index that was underperforming earlier, Russia, that was high by about 1.6%, whereas Brazilian index, which was up by almost 8 to 10% this month itself, saw a bit of a pullback out there, down by about 3%. So divergent moves, but most of them in the red and by a large amount.
Okay, well, let's tell you about the currency space. The dollar index holds on to overnight levels, while the Japanese yen has strengthened on demands for safe haven assets.
In the world of commodities, crude oil prices fall in trade but fails to mirror the sharp sell-off in the US stocks. The Brent trades around $75 per barrel mark, whereas the NYMEX around that $66 per barrel mark.
All right, time for a quick break now, but all the cues and news you need to work with for trade this morning on the other side.
And on a quick programming reminder, CNBC TV 18 launches a special initiative in partnership with the National Stock Exchange. On the 25th of every month, we tell you how investing in the stock market or equities makes one financially disciplined. This is a monthly program to inform and educate investors about smart investing and enabling the journey to wealth creation. Catch our special coverage all through the day only on CNBC TV 18. Welcome back. You're watching Power Breakfast on CNBC TV 18. The Asian markets, no respite out there. They had tumbled early morning, taking cues coming in from the Wall Street, and now we're getting in early rates from the Hang Seng, which is lower by about 500 points. Shanghai index, which is trading close to its 4-year lows, is relatively muted, but the other Asian indices sitting with a cut of anywhere between 2.5% to 3.5%. In that regard, the SGX Nifty indicates an opening of 100-point lower, 100-point downtick is what is on the cards. But moving on, the government coffers, they could be under pressure this month as the September's GST collection could remain subdued. Sources tell CNBC TV 18 that the GST collections could be around 94,000 crores as against the asking rate of 1.15 lakh crores a month. Tim C. Jaipuria joins us with the expectations from the September data. Tim C., what are you picking up?
After having seen a marginal recovery in the collections figures last month, GST collections are likely to remain subdued in the month of September as well, for which the filing period is still on. The last date is tomorrow for filing GSTR 3B, and government sources tell CNBC TV 18 that when it comes to the overall collections, they are likely to range between 93,000 odd crore rupees to 95,000 odd crore rupees. When it comes to the number of returns that are likely to be filed for the month of September, for which it will be recorded in October, they are also likely to range between 65 to 67 lakh returns, which is again a decent, healthy number. Yes. However, revenue leakage continues to be a concern. GSTN glitches continues to be a concern. Non-compliance of e-way bill system, non-compliance of declaring full sales figure, etc. are the areas of improvement which government aims that better enforcement of GST, better administrative measures are likely to put in more pressure so that better numbers come in so far. Yes, when it comes to the collections and the asking rate is around 1.15 lakh crore rupees per month according to the budget targets, and we are still about 20,000 odd crore rupees below that, and government feels that in the latter half of the fiscal year is when government is likely to see a pickup in the collections. But yes, let's see what finally happens. What are the numbers that actually come out on 1st of November? We'll keep you posted. Back to you.
Okay, thanks very much for that. Well, let's move back home then. On Dalal Street, the markets recovered in the last hour after the Nifty lost around 0.5% or ended 0.5% higher, and the Sensex rallied to reclaim the 34,000 mark. The Nifty banked to reclaim the 25,000 mark, while the mid-caps outperformed with gains of more than 1%. We have Sonia joining in this morning to tell us all of the cues she's tracking. Well, Sonia's not looking that great.
Well, not great at all. I mean, the writing is on the wall. You know, the SGX Nifty is down about 100 odd points. There was a huge slide in the US markets, and that's going to be the overarching theme today. The Dow was down 600 points. It's erased all of the gains of 2018. Not just that, October has been a pretty rough month for the US markets. You know, the S&P 500 and the Dow are both down about 7 to 7.5% this month. The Nasdaq is down in double digits this month, and it's actually the triple overhang, one of the Fed rate increases. But I think the bigger issue really is the trade tariffs, the impact it would have on US corporate profits, as well as the slowdown that we've seen in China, and of course all of that impacting equities. The Japanese markets this morning, in fact, are down 3% following the Wall Street sell-off, and we've also seen the dollar index strengthen quite a bit. So now the dollar index is above that 96 mark. FI sold in trade yesterday. They sold more than 2,000 odd crores, although we did get a buy figure from the DIIs. The market could see a gap down opening. Whether we see buying or not post that, only time will tell. But for now, the SGX Nifty is down about 100 odd points. The only positive is that Brent crude continues to remain quite subdued at a 2-month low, trading at just, you know, a little above $75 a barrel. It's F&O expiry today as well. The Nifty is down about 6.5% in October, and the mid-caps are down about 4.5%. So it looks like it's going to be a pretty rough morning of trade.
Absolutely, Sonia. Looks like a rough morning of trade. What are the stocks that you're watching out for in trade today, for whatever they're worth, given there could be a top downfall?
Oh, you know, there's been more misses than hits in this earnings season. Interglobe reported a shocker this time around. We were expecting weak numbers, but this is really the weakest that they've seen in the history since listing. A net loss of 650 odd crores. The EBITDA margins have hit a record low of 3.6% after being in high teens for at least the last 4 to 5 years. The EBITDA, just to give you the number, has come in at 220 crores versus an average of 1,700 to 2,500 crores over the last many years. So a shocker of a number. M&M Finance had a good quarter. NI growth of 49%. The profits have more than doubled this time around. Wipro was a decent quarter as well. Dollar revenue growth of almost 2%. Constant currency revenue growth of 2.8% quarter on quarter. Bajaj Auto fell 5% yesterday after the management said that the margins could continue to be under pressure. Macquarie has come out with a note saying that they maintain an underperform and the margin disappointment continues. So that stock could be under further pressure. Hexaware saw weak earnings, so added to the mid-cap IT weakness this time around. Dollar revenue growth just 1.6% versus expectations of 4%. Lakshmi Vilas Bank posted another quarter of losses. 4th quarter in a row they've posted losses, and this time the loss at 132 odd crores. And you have a long list of results today. Topping the charts, you have Maruti, Bharti Airtel, JSW Steel, Yes Bank, some of the smaller names like Biocon, Dish TV, BHEL, PVR. So, you know, the day is long, and it looks like it's going to be a rough start to that one.
Yes, absolutely. Well, thanks, Sonia, for that. So time for a break now. But up next, the government wants the Reserve Bank of India to remove some thresholds of the PCA framework. We'll get you details on this once we're back. Welcome back. Well, let's see whether this gap down sustains, worsens, or maybe there is some amount of buying on dips that we could see on our markets. But as of now, the SGX is indicating that it's going to be a tough start for us. But let's move on then. We learned from sources that the government wants the Reserve Bank of India to remove some thresholds from the Prompt Corrective Action or PCA framework. Government wants even the capital thresholds relaxed. Lata is here with the details on this story. Lata, morning.
Well, there was the Reserve Bank board meet day before yesterday, and it looks like the entire board meet was dominated by the government asking the Reserve Bank to lower the thresholds of putting banks in prompt corrective action. And it appears that the government has also told RBI that even the capital thresholds that RBI is demanding is very high and they should be relaxed. Of course, the other thresholds should be taken off altogether. Now, just by way of backgrounder, the Reserve Bank puts a bank under prompt corrective action when its capital falls below a certain level. If it falls even lower, it's called a threshold 2, risk 2. And then if their net NPAs are above a particular level, if they're above 6% net NPAs, then they go to threshold 1. If they are above 9%, they go to another threshold. And with each level, there are restrictions placed. You can't have branch expansions. In some cases, you can't even grow your book until you bring in fresh capital. And no director fees, no dividends, the usual restrictions. Now, what the government is saying is that this is preventing growth, and that your restrictions in world over, capital is the only threshold. Nobody looks for a NPA threshold as well to stop banks from lending risky loans. The Reserve Bank's position is that, on the contrary, their rules are easier. The world over, the NPA threshold is not there, because the moment a loan becomes an NPA, it is provided for, 70, 80%. In India, the provisioning is it's minimal. It's only 15% in the first year, 30% in the second year. So the Reserve Bank's argument is you will have to anyway use the capital to provide. And that is why we are asking for more capital. That is why we have 2 thresholds and not 1. So that's where the argument is. Viral Acharya, the Reserve Bank Deputy Governor, had quoted chapter and verse in a recent speech on October 12th. And I assume those arguments were made in the board meeting as well, that our rules are not strict. And, we have to stick with these, because otherwise banks may end up lending risky loans. And it is not as if the banks are not allowed to lend. They are not allowed to lend below BBB and below. They're asked to lend A and above, because they already have a lot of risky loans. Now, this tussle is going to take place. It started with the board meeting and it will continue. The Reserve Bank asking more capital to be put on the table, and a government saying that unless growth happens, the banks will not be able to make their own money, and they cannot all constantly be fed by the government. It looks like, with the credit crunch continuing, the Reserve Bank may give in a little bit. We don't know, but the tussle continues as of now.
All right, Lata, thanks a lot for that. The tug of war continues. But with that, we move on to some earnings. Wipro reported a good quarter, and the third quarter guidance, or rather Q3 guidance stated by the management, is in line with what the street was expecting. Rima joins in now with the highlights. Morning, Rima.
Hi, yes, Wipro has reported a fairly good quarter. On Q2, revenues and margins are higher than what the street was anticipating, and the Q3 guidance is in line with expectations. So dollar revenue growth for the September quarter has come in at 0.7%. If you adjusted for the sale of the hosted data center business, which took place last quarter, the dollar revenue is actually up 1.9%, and on a constant currency basis, it's higher by 2.8%. Of course, this is boosted by 1 month contribution from the Allied acquisition, which will actually feed into the company's guidance as well. With respect to margins on a reported basis are impacted because the company had to make a one-time settlement of 500 crores towards the National Grid lawsuit. But if you adjust for that, the margins have come in at 18.1%, which is actually higher than the expectations in the market. So that's the reason why we say revenues and margins are actually looking better compared to the tepid expectations. Q3 guidance is at 1 to 3% in line with expectation, and the guidance, of course, is boosted by an incremental 2-month contribution from the Allied acquisition. Breakup, BFSI continues to be strong while healthcare continues to be muted. Now for Wipro, the valuations are inexpensive when you compare it to peers. It is trading at 14 to 15 times F520 PE. The stock is down 2% in 2018 versus the Nifty IT, which is actually up about 20%. So there is a serious underperformance. Now, given this quarter is quite healthy, it's slightly better than expectations, there is a case for Wipro to play a bit of catch up. But the big question is, Wipro has failed to deceive in the past. It's had, a couple of good quarters, but it's never managed to follow it up with a sustained performance. And that, big question will continue to remain for Wipro. Back to you.
Okay, all right, Reema. Thanks very much for that. That's on Wipro and the review. But moving on to earnings expected today, we have Bharti Airtel, which is going to be coming out with its Q2 numbers. What are the expectations?
Well, you know, Bharti Airtel could actually report a loss for the first time in 15 years. So we're working with a loss of close to about 800 crore rupees. Now, Bharti, as we know, is a tale of two cities. The India business is getting quite hit hard on account of competition, while Africa has been on a turnaround path. If you look at the consolidated revenue growth, that is expected to be marginally higher because on one hand, you have the India revenues, which are expected to be lower by 3%, but it will be offset by more than a 6% increase in the Africa business's revenues. With respect to margins, consolidated margins will be lower on a sequential basis, and that's because the India business is expected to see a fall of close to about 300 basis points plus in their EBITDA margins. So even while Africa continues to show an improvement in margins, the net impact will be on the margins. As we pointed out, this time around, our poll is throwing up a loss of close to about 825 crore. For the India business, this is expected to be a weak quarter because one, it's seasonally weak. There is a full impact of Jio's entry into the postpaid market, the Jio Monsoon Hangama offer, and plus there is a down trading of the average revenue per user. People are opting for cheaper bundle packs which are in the market. So which is why the average revenue per user for Bharti is expected to now come down to 99 to 100 rupees. Now this will not look good when you compare it to Jio, which is actually at 131.7, but ARPU pressure will be watched closely. Africa has been doing well. As we had pointed out, there will be a revenue growth of 6%. Margins will improve. In fact, for Africa, the margins have improved by nearly 16% from margins of 20%. They've already come to about 36% in a span of 3 years, and they're expected to improve further. What will be the key things to track, which could be a trigger for the stock? One is an improved performance in the India business, which of course is only a function of competition. And secondly, the deleveraging plans. The company has already announced one step where there will be a primary infusion of $125 billion into the Africa business, but there, the expected listing of the IPO for the Africa business will also further help in deleveraging the balance sheet. So that will be also a trigger to watch. The stock, of course, has been an underperformer, but yesterday it put in a very smart rally towards close.
Absolutely. Thanks a lot for that, Reema. So those are the details that we will be watching out for in Bharti Airtel. But we slip into a short break. Come back. We get your expectations from Maruti when it reports its numbers today. Welcome back. This is Power Breakfast on CNBC TV 18. The big talking point is the sharp sell-off that we saw on Wall Street overnight. Asia has continued that decline. The Hang Seng is now lower by about 600 points. The Nikkei lower by about 3%. Our markets, the SGX Nifty, if the lead is to be believed, indicates a start lower by almost 100 points. So what is plaguing these global markets, and is there an end in sight to that? We have Seth Freeman, the Senior Managing Director at Glassratner Advisory Capital Group, LLC. Seth, thanks a lot for joining in. What do you think has caused this sort of sell-off, and is this transient in nature or is this more structural?
Well, hopefully it's more technical than structural. There's concern about earnings, concern in the U.S. about inflation, and also, frankly, having 5 or 6 bonds, 2 of which mailed to ex-presidents, among other officials, doesn't really help the market very well.
Seth, in your opinion then, how exactly is India looking? Because we do have the possible tailwind of lower Brent crude prices, and we've seen it fall rapidly from levels of 86 just a couple of weeks ago now to, just about 76, 75. So what's your sense in terms of where India stands if in case there are these macro, tailwinds for us?
Yeah, well, for sure, being such a big, as we all know, such a big oil net importer, rising crude combined with the rising dollar really puts a lot of pressure on the Indian currency and the Indian economy. This morning I was reading that the Saudi officials said they were going to pump as much oil as they possibly could. And I don't know whether this is partly a result of wanting to maintain, their market share, or it's some form of some bizarre form of apology for the most recent events that we all know about. So that might be helpful for India in the short run.
Right, that might be helpful for India in the short run, but do you think in the wake of the sharp sell-off that we're seeing across the globe, any one index could actually stand up? If not, then where would you advise one to put their capital?
Well, I remain a long-term, have a very long-term view on investing in India and the Indian economy, economic growth. The situation is, frankly, there might reach a point soon where U.S. foreign investors are going to find emerging markets, and particularly India, more interesting again if the sell-off, does continue. Because the fundamentals aren't really changing from a long-term viewpoint. These are basically money flow problems.
How much of this sell-off that we're seeing in the U.S. equities is because of what the Fed might do going forward, Seth? Is there fear that there could be further tightening when there is some amount of macro data which is not, indicating that growth is as robust as maybe what it was thought to be?
Well, the different governors are talking fairly consistently about 2, if not 3, increases between now and 2019. There is a chance of overshooting with increases. We are not seeing substantial wage increases, but we are seeing price increases. And so that can be a problem if they overshoot. I think one of the bogeys is, frankly, some of these tariff and so-called trade war issues. That creates some additional unknowns, and it's kind of hard to tell right now what's going to happen, particularly between the U.S. and China.
Okay. All right, Seth. Thanks very much for your quick take in terms of what's taking place in the U.S. markets. Thanks very much for that. So that's some global opinion coming in there. But on to a quick programming reminder. CNBC TV 18 has launched a special initiative in partnership with the National Stock Exchange. On the 25th of every month, we will tell you how investing in the stock market or equities makes one financially disciplined. This is a monthly program to inform and educate investors about smart investing and enabling the journey to wealth creation. Catch our special coverage all through the day only on CNBC TV 18.
With that, it's time now for a short break. Come back, we talk about Interglobe Aviation reported a howler of a quarter. More highlights when we return.
Welcome back. Well, Indigo reported its Q2 numbers after market hours yesterday. The margins have come off to record lows. It was an extremely disappointing set of numbers. Sonia is here to take us through the key highlights. Sonia.
Well, Ekta, I shudder to think what the fate of the other airline companies would be when a market leader like Indigo has posted such disappointing numbers. Such is the case in the aviation space. Very, very disappointing numbers coming in. Record lows in terms of EBITDA, in terms of margins. Yields have fallen 9.7%. And overall as well, the net loss has come in at 652 crores. Now, it's not so much about the fuel costs. Fuel costs have gone up for the entire sector. It's the other costs that have increased for Interglobe Aviation because of the grounding of the A320 Neos, etc. So fuel costs have risen substantially. Other costs have gone up by 40%, putting a lot of pressure on yields. The EBITDA, the earnings before lease rentals, have hit a run rate of 220 crores. Just to give you, the average over the last 5 years has been about 1,500 to 2,000 crores, and now it's come in at 220 crores. Massive erosion as far as margins are concerned, and the yields also have come in at a multi-year low, down almost 9.7% year on year. The stock, of course, has factored a lot of this in. It's under a lot of pressure. It hit a 52-week low this month. So let's see whether there's more downtick on the stock, but the numbers have definitely disappointed the street.
Depreciation also had an adverse year-over-year impact of 1.4 billion rupees on our dollar-denominated expenses. So the overall impact of currency depreciation increased our costs by 4.3 billion rupees compared to the same period last year. Unfortunately, these higher input costs have not been recovered as fares remain low due to continued intense competition. Similar to the last quarter, the 0 to 15-day booking window remains weak with lower fares compared to the same period last year. We have taken several steps to create efficiencies and improve productivity as we scale up. For example, we have adopted various initiatives to reduce the fuel burn on our planes by reducing weight and improving navigation and landing procedures. We've also improved the productivity of airport operations through better cross-utilization of resources. We have refined our maintenance schedule to improve aircraft utilization by carrying out activities during the night.
All right, so that was the management of IndiGo speaking in the earnings call. However, the company's performance was not good at all. But Sonia is still with us. Sonia, Maruti is going to report its results today. What are the expectations there?
Well, you know, for Maruti, growth has slowed down substantially in this quarter because of the weakness in retail demand, the slowdown in rural demand, etc. The volumes for Maruti has actually declined by 1% this time around. And although they did raise prices by 3.5%, they took some price increases. The overall revenue growth will just be about 1% because of the volume decline that we've seen. Now, the realizations, as I said, will rise about 3% year on year to 4.55 lakh rupees a unit because of the favorable product mix as well. They sold higher number of high-cost products like the Baleno, the Brezza, etc., which will aid their realizations. However, the margins will decline 260 basis points year on year because of the weak revenue growth as well as the rise in raw material costs. Discounting was very high as well because of the weakness in demand, and that will impact their margins too. So just to give you the numbers, a revenue growth of just 1.5% is what we're looking at. This figure could be around 22,000 odd crores. The EBITDA will fall by 13.5%. We're expecting the margins to erode by 260 basis points year on year at 14.3%, and the profits to fall by 17%, coming in at almost 2,059 odd crores. The stock has perhaps priced a lot of the bad news in because it has fallen about 30% in 2018 already. Back to you.
Okay, all right, Sonia, thanks very much for that. But the big story this morning remains the global space and shifting focus back to the big sell-off that we've seen across global markets. In the US, it was a brutal sell-off with both the Dow Jones and the S&P 500 giving up gains for the year, and the Nasdaq now entering correction territory. There was a sharp drop in tech stocks, and worries about corporate earnings really added fuel to the fall. Asia too is seeing deep cuts. The SGX currently is indicating a gap down start to our markets. Okay, well, on that note, let's listen in to what market experts have to say about the sell-off taking place in the US as well as the outlook going forward.
What we are seeing from markets right now is an inherent fragility. Volatility remains high. Investors are shooting first and asking later. And in response to a lot of comments coming out of companies, none of them overly concerning in and of themselves, but nevertheless, investors are looking at them and saying, I'd rather just take down my risk right now, and I will reassess what these issues are. The concerns that people are citing now are the same concerns that we've seen at the beginning of the year. And when we look at the earnings backdrop coming out of corporations, we have their comments. Yes, some of them people are gravitating towards, but by and large, the results so far have been pretty spectacular. The breadth of companies beating is very strong, 75%. The amount they're beating by is right in line with historical averages.
The very rapid move higher in 10-year yields, 20 basis points in just a few days. That stabilized, so that's a check. Then we had a little bit of an accelerant to that fire, which was a lot of the systematic selling that had to take place. As you had both bonds and equity selling off, volatility jumping higher. We would say that's largely complete as well, so that's a check. But then you were supposed to be left with really your fire extinguisher that are fundamentals, that are earnings. And that's where I think we're still going through a little bit of a digestion, resetting of expectations phase, where it goes from, yes, earnings are really, really good, but we're probably past the phase where we're just revising earnings higher and higher and higher. So now we're thinking about, wait, maybe 2019, 2020 earnings expectations are a bit too high. Maybe they actually need to be revised lower.
You've had no safety here in October where bonds are down, equities are down, and I think that's been exacerbating some of the selling from the multi-asset community as well. I think are we good from an equity perspective, is now a good time to buy. You've had a derating that's in line with what we saw in 2015 and 16. We hit a level and a multiple yesterday that we hadn't hit since the depths of January 2016, when earnings hadn't grown for 18 months. We had a dollar shock.
That's interesting.
And we had an oil shock.
All right, on that note, we slip into a short break. Come back, we get you a check on the cues to watch from the futures and options space ahead of the October series expiry.
Welcome back. Well, let's get across to Manisha Gupta, who joins in with an update on all what's taking place in the commodity and the currency space. Manisha, morning.
Morning, and thank you so much for that. Well, it really is the extreme pressure that commodities are facing because of the sell-off in equities in the global markets. So if you look at the crude oil prices, we have seen yet another percentage decline in the overnight market. Crude prices are now down 9 to 10% in this month alone. And we have seen pressure not just because of equities, but also the fact that there are reports suggesting that the demand growth will slow down. There are borrowing costs gaining. The EM currency route that also has, been a big fundamental here. And then, of course, markets also continue to look at the U.S. inventories, which have been increasing. And this is a fifth straight buildup in U.S. inventories. That seems to be pulling the prices down as well. The only thing that the markets watch as uncertainty is the U.S. sanctions on Iran that take place on 4th of November. So ahead of that, you will continue to see a lot of volatility continuing in crude prices. And even as the U.S. dollar is trading at a 9-week highs, we have seen the gold prices continue to behave as a safe haven commodity after all, holding above $1,230 per ounce. It's trading at a 3-month highs. So when you look at all the commodities overall, it is only gold prices which continue to provide that hedge.
All right, only gold provides that hedge, but more importantly, you have to keep an eye out on the F&O space, the equity markets, because it is the October series expiry. And what a rough series we've had so far. The bears have the ammunition of close to 750 points. That's what we've lost in October so far, one of the largest cuts that we've seen in at least the last 10 years. Also, this comes on the back of a 700-point cut in September itself. So nearly 1,500 points shaved off the Nifty in just the last two series. The rollovers have been high, so there is a fair amount of conviction as well, 65% so far. And remember, we still have a day to go for expiry. Smart money yesterday was playing for a range of anywhere between 10,100 to 10,300, and that's primarily because the 10,200 put and the 10,200 call together have a premium of 100 rupees. Whether we hold on to that support or not is the big question, because if we do hold on, then it is the range 10,100 to 10,300. If we do not, then all bets are off. It's the Nifty Bank weekly options expiry as well. Watch out for that. And finally, DHFL on expiry day enters F&O ban.
Okay, all right, Mangalam. Thanks very much for that. And on that note, we're going to wrap up on Power Breakfast. Stay tuned. Bazaar Morning Call up next.